What's good, y'all? Today we caught some US30 longs. It's a new month, so I was looking for price to at least take out the previous day's higher. We had some higher time frame PDRAs that you'd see in the video. I'm gonna let the video play out. I'm gonna put some type of background sound, for y'all to listen to as the trade plays out. Let me know what y'all think about the video. Make sure to comment, like, and subscribe. This was all done on live, by the way. So make sure you tap into the live stream.
Used either by my presentation, which I'll admit sometimes I'm not always the best in terms of articulating when I'm ranting. I'm just basically going where I'm feeling led by at that moment. And today, I kind of like a little bit more focused because I want to draw a very stark separation between daily bias in the marketplace and narrative. And I want to open it up with initially stating that the bias on a market is absolutely not a narrative. Okay. And I've had over the years students come in and say, hey, look, it's most important. What should I focus on initially? Like, what's the first thing as a developing student, trader, or someone that's a break-even type trader? What should they focus on first? And they think it's entries. Tell me how to get into a marketplace. How do I know when to buy it? How do I know when to sell it? What's the entry mechanism that never fails? What's the buy signal and sell signal that allows me to not worry about even placing a stop loss because you're too panicked to get in there and start trying to make money? But you have to first realize the risks. And before you even get to that stage of knowing when to buy and when to sell, or even stop losses, because they're pretty easy. The very thing that you're afraid of the most, placing stop loss and controlling the risk, that's the easiest thing. That's the easiest thing to do. And you can tell, and I was guilty of this in the beginning too. As a 20-year-old, I was afraid to place a stop loss because I was afraid I'd be wrong. I was afraid they would stop me out. And at the time, I didn't think of a collective day, doing the air quotations with that. I just figured that the market would just come back and get my stop and then run without it. And I didn't even have enough experience at the time to even warrant that fear. But it just goes to show that that's what we're afraid of. We're afraid of being wrong. We're afraid of losing money. As an investor, as an entrepreneur, as a trader, you got to warm up to the idea that you're going to do it wrong. The market will sometimes just be stupid and do something that you did not expect. Okay. And that might incur a loss. So the bias on a marketplace, that's very simply, are you bullish or bearish? Now you can be bullish or bearish on the daily chart, the weekly chart, and have a very long-term or intermediate-term bias. I'm bullish on gold. I'm bullish on equities. I'm bullish on whatever currency you're interested in. But for what time frame are you bullish? Because I could be bullish for 10 minutes trading in a 15-second chart, but inside of a long-term macro bearish market, and I can trade profitably doing that. So many of you are so rushed to try to get into something, you're not giving yourself the adequate time to learn how to trust a bias, and then moving past that to where the rubber meets the road is narrative. See, bias is rather simplistic. You arrive at that on the weekly chart. You arrive at that on a daily chart. Is the market going to go higher to an old pool of liquidity, an old relative equal high, two highs that are real close proximity to one another, and the most recent one being slightly lower than the previous? That's like king. Okay, it's where all the retail traders are going to feel real safe if they can short, placing their stop loss just above that. So I teach you to try to reach for that. And that is simply cut and dry, as easy as you can get for a bias. Whatever time frame that exists on the relative equal highs, that's the time frame that you're bullish. Does not mean you won't have down candles. It doesn't mean you won't have down days in between where it is right now and when it gets there. But all too many times, traders see a down day when it's unlikely bullish. I'm about to just throw everything out the window because it probably just reversed because we had a down day closed down 150 minutes. That doesn't mean anything in today's solid. I shouldn't have any, I guess, bearing on what you believe is bullish on that time frame. In fact, it's good that there's down days in higher time frame charts like that, because that's how order blocks are created. The market trades above that down close candle, and it comes back and touches its opening price. And then you have a change in the state of delivery for the short term, but it's already been bullish. You see how quickly a neophyte, someone new, can get lost in the time frames and feel like, I don't know what I'm doing. The sands of time are just carrying me here and there, and I don't know what I'm doing. Why is ICT calling it bullish? Why is he looking for it to go here? Why is he looking for it to go there? Why didn't he do this and why didn't he do that? That's what we're talking about today. Narrative. See, it's not enough to know that it's likely to go up. It's not likely to go straight up every single day when you're bullish. In fact, it's unreasonable. Unreasonable to accept. And when it can be seen, far less likely that it doesn't go up. It's narrative. Out of all the books I've bought, all the authors I listen to, even people that claim to have made lots of money, even my initially, first mentor, Larry Williams, his tools, rather simplistic, but didn't really get to the core of what I was aching for was, how do I navigate this stuff? Even if I see all the things that I had grown to trust as a brand new student of his, 1995, I had to find my way through all that stuff because I would overanalyze, I would second guess, I would sprinkle this and that from everybody else that I thought I was learning good stuff from. And it wasn't helping. It wasn't helping at all. Because I didn't know the mechanics of what was going on behind the scenes with liquidity, time-based delivery. And that's the crux of what makes algorithmic price delivery what it is. It has absolutely zero to do with how many people are buying and how many people are selling. And it's silly when you think about it because you say, oh, look at the buyers. They're buying pressure. Here's how you quickly throw that into the bin, okay? You cannot get filled on a long purchase of any instrument at all unless someone took the other side of it. So there's transactions there. They're on both sides. It's funny how everybody misses the idea that it's going up. No matter how many contracts, how many shares, how many lots are trading, whatever entity state the other side doesn't matter. It's still the same buying and selling pressure at the same time. But you'll believe the books. You'll believe the authors that regurgitate everything else the books have taught. And it's funny how you're always learning and never coming to the knowledge of the truth. You're never getting there because you're believing the lies and you're drinking from the well that's tainted. If you go in looking for things that are false, not realizing what you're looking for is false, it's flawed logic. And it's easy to grow accustomed to saying, well, this game is random. It's not an even distribution of buying and selling winners in my trading. I have to always be willing to see the market go into states of randomness. And that is otherwise. Everything's in here. Down to the tick. Proof of that is you can see it before it happens, and where it trades right to a specific level, down to a quarter point or it stops. And one has to admit, either the world collectively is listening to little old me, a nobody from Middle River, Maryland, and they're all marching to the beat and drum, the Pied Piper playing, and they're buying, they're selling, they're stopping exactly where I said that level should be sensitive. Or, and this is the truth of what it is, the market should break. And they're set to that level by algorithmic price level. It doesn't matter. All of a sudden, nobody wants to buy above that tick high. No one wants to sell below the tick when it's been dropping, right where we say it's going to go to. Isn't that odd? Isn't it odd? Okay, look at your level 2 data. Those that believe it. But there's still orders above these levels. Why aren't they getting tagged? Because they're not part of the party, folks. They're not being invited. They're just left outside. The 501 Club, the people that are in the mix right now, they're in there. They're moving and shaking. They're in there. They have been ushered in to the hottest place right now. That's the volatility in the marketplace right now. They're in there. And you always have people that are out